Today, we are diving into a topic that every mutual fund investor needs to understand: exit load in mutual funds. If you are deciding to sell your mutual fund units, understanding exit load is something absolutely crucial. Selling your investments is not something you should be doing arbitrarily. It's an integral part of the investment process that requires careful consideration. In fact, in one of my earlier articles, I discussed why it's so important to have strong and valid reasons before redeeming your mutual fund units. I've shared the link to that article in the description box. So do check it out after this video. Let's start by understanding what exit load actually is. When you sell or redeem units of a mutual fund, whether partially or fully, within a specific time period from the date of your investment, the fund house imposes an exit load. Think of it as a penalty for withdrawing your investment prematurely. The exit load is calculated as a percentage of the NAV or net asset value at the time of redemption. For example, if you are redeeming units worth Rs 22,500 and the exit load is 1%, you will be charged Rs 225, which will be deducted from the total amount before it's credited to your account. That leaves you with Rs 22,275. It's a straightforward calculation, but understanding it can make a big difference to your investment decisions. Now, let's talk about how exit load works in the case of SIPs or systematic investment plans. This is where things get a little more complicated. Exit load is applied to SIP installments that haven't completed the stipulated time period. The concept of FIFO or first in, first out is used here. This means the oldest SIP installment is assumed to be redeemed first. If that installment hasn't completed its time period, the exit load applies. On the other hand, if it has completed the stipulated time period, no exit load will be charged. It's very important to remember when planning redemption from your SIPs. You might be wondering why fund houses even charge an exit load. The rationale behind this is to protect the interest of long-term investors by discouraging premature redemptions. When investors redeem their units too soon, it can cause instability in the fund. This is especially true for equity mutual funds, which are designed for long-term horizons of 3 years or more. That's why equity funds typically have higher exit loads compared to debt funds. If you are looking to avoid exit loads altogether, consider investing in equity-oriented ETFs or index funds, as many of these do not even charge an exit load. Similarly, liquid funds and overnight funds often come with no or minimal exit loads, making them a great option for short-term investments. Now, let's discuss some special cases where exit loads might apply. For example, if you are switching from one scheme to another within the same fund house, an exit load may be charged if the stipulated time period isn't completed. The same applies to STPs or systematic transfer plans, where money is transferred periodically from one scheme to another. Even in SWPs or systematic withdrawal plans, exit load is applicable if the stipulated time period hasn't been completed. It's crucial to plan these transactions carefully to avoid unnecessary costs. Exit load isn't the only cost to consider when redeeming mutual funds. Taxation also plays a significant role. For equity mutual funds, short-term capital gains when units are held for less than 12 months are now taxed at 20%. Long-term capital gains, on the other hand, are taxed at 12.5% if the gains exceed Rs 1.25 lakh in a financial year. For debt mutual funds, both short-term and long-term capital gains are taxed as per your income tax slab. It's important to factor in these tax implications alongside exit load when deciding to redeem your mutual fund units. So let's put things into perspective by comparing mutual funds with other investment options like FDs and debt mutual funds. Tax-free bonds, for instance, often provide the highest returns due to their tax exemption. On an investment of Rs 1 lakh, a tax-free bond with a 9.1% coupon rate yields Rs 9,100. In comparison, an FD with a 6.25% interest rate yields Rs 6,250, and a debt mutual fund with a 7.58% coupon rate yields Rs 6,064 after LTCG tax. Clearly, understanding the nuances of exit load and taxation can help you maximize your returns. To avoid exit loads, the best strategy is to stay invested for the stipulated time period. Plan your withdrawals or switches only after the time period has elapsed. Additionally, Opt for funds with no exit load, like ETFs or certain liquid funds, if flexibility is a priority for you. Aligning your investment horizon with the fund's objectives can also help you minimize cost and maximize returns. Exit loads is an essential concept in mutual fund investing. It's designed to encourage disciplined, long-term investing while protecting the interest of all investors. However, it's not just about the exit load. You also need to consider the tax implication and overall cost when redeeming your mutual fund units. By making informed decisions and planning your investments carefully, you can avoid unnecessary charges and stay on track to achieve your financial goals.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high-performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign-up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert-curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.